Welcome to the Net Wealth Nest podcast, the show that helps everyday people build real financial stability, starting from wherever you are. Whether you're working your way out of debt or just starting to save, we're here to help you grow your net wealth to your first big wealth milestone. Each episode, we break down the mindset shifts, practical tools, and real-life actions that can transform your financial future. Thanks for tuning in. Now let's get to work building your net wealth nest. Hi, everybody. Welcome to Net Wealth Nest podcast. I'm your host, Jim LaBeouf, and today we're going to take a moment to talk about investing and the basics and how to start investing. We're going to start off with a little bit of why investing is important. Compared to just putting your money in a bank, investing will allow your money to grow over time without you having to do anything with it or to it. So if you think about having to trade hours of work to gain money, as an example, this is a way of putting in something where you're not trading any of those hours to watch that money over time grow. Now, there is obviously inherent risk with the stock market, especially in a smaller time frame where it can be very volatile. But if you look at the market holistically over the course of 5, 10, 15, 20 years, it continues to just grow up and to the right. The best analogies I've seen with this, understanding the day-to-day or even month-to-month volatility of the stock market, and then the long-term projection of what it looks like, is imagine that you are walking up a pretty steep hill with a yo-yo. Daily, that yo-yo going up and down as you're yo-yoing it, but you're continuing to go higher and higher. It's just taking much longer to go higher, whereas the yo-yo is up and down very quickly. And that's a great way to look at the stock market, is that yo-yo is going to happen day in and day out, month in and month out, or even quarterly. Sometimes even years, depending on if we're in a recession or any of these types of things. But over the long term, if you take a decade or 2 decades, there's a consistent graph that goes up and to the right and allows your money to grow without you necessarily having to do anything with it. And the more you invest, the more it's able to grow. The more consistently you invest, if you're doing it every month or every paycheck or every quarter, will help you compound your growth. And to talk about that growth a little bit before we get into how to do that, what does that mean? And so I'll give you an example. Many people are familiar with the financial crisis that happened in really from the end of 2007 all the way through 2008, 2009. The housing market crashed, stock markets crashed everywhere. It was a big financial issue, billions and trillions of dollars lost over that time. However, people who stayed in the market over that time were able to gain back that money and much more. So for example, let's just say you had $1,000 and you invested it on the lowest day, which, but looking it up and Googling it, it looks like March 9th of 2009 for the 2008 financial crisis. So if you would have done it almost, and today, just for reference, is mid-2025. So that would have been roughly 16 years ago. If you would have invested $1,000, and let's just say you put it in an index fund. And an index fund is just a fund that houses multiple stocks, so you're spreading out your investment. So for example, many people know about the S&P 500. It's the top 500 companies, and it's very popular to put into a portfolio and have diversification over those 500 different stocks that you own itty bitty pieces of. And so let's imagine that you had $1,000 and you put it into a standard index fund, and at that worst day in 2009, and then you just let it sit there. You didn't add any more money to it. You didn't do anything with it. You just let it do its thing. As of today, by the calculation I have on here, you would have that $1,000 would now be worth $8,280. So $8,280. So your money has, over the course of 16 years, gone up eightfold, meaning every 2 years, basically, you were doubling up your money, which is outstanding. And you will not find too many offers or investment products where you can double your money every 2 years. Now, is that necessarily consistent? No. Is that where we're starting at the lowest and taking the highest, so we're getting the maximum amount of gains? But even if you started in 2000 and had $1,000, that money today, so now we're talking about 26 years, right? In today's money, which means that over 26 years, again, eightfold. So every 3 years, you were doubling up your money. Still great. Now imagine if you had started with $100,000 and now you had $820,000. So that's why investing is important. It's hard for our minds to grasp how compound interest works, but that's the math that shows you exactly where the growth is. And so how do you go about investing, especially in like the stock market as an example? And this is really what this video is focused on. Is the first thing to do is to choose a firm or a brokerage that you want to invest with. So there's many out there. Some very popular ones are going to be like Vanguard, Fidelity, Schwab. Those are just three that are really popular out there. E-Trade is another one. And so you can go out there and you can open up a free account with those brokerages, and you can take money from your checking account and you can put it in an account in there, and then you can pick what you want to invest in. The easiest thing for people to invest in is to look for indexes that you can invest in. And again, an index is something that spans a large amount, and they usually mirror categories in the stock market. So the Dow Jones Industrial is a very popular one. It's where we hear the most about the Dow on a daily basis, on how the economy is doing and where the market's at. The S&P 500, as we mentioned before, is another one. There are indexes that cover maybe energy. So it could be gas, or maybe it's solar energy, or there's a lot of different, there's car indexes. There's all these different indexes. What we typically tell people that are just starting off is follow one of the two big ones. Either do something with the Dow or do something with the S&P 500. The S&P 500 typically has better returns than the Dow. Not always, but it typically does over the course of time. And the more you can put money into there and continue to put money into there, the more you're going to see the benefits in compound interest. So once you open an account, you'll go in there and you can search on, they'll have indexes, they'll have mutual funds, they'll have ETFs. Usually mutual funds and ETFs are managed by an individual, which means you're paying higher fees. An index fund is usually managed by a computer because it's just copying what the market is at. So all those companies that are underneath the Dow Jones, that are qualified to be in the Dow Jones average, or all the companies that qualify to be in the S&P 500, they are just there. And so it really doesn't take anybody to manage those. If a company drops out and a new company comes in or whatever happens, like a computer can just automatically do that. And so the fees are really usually pretty low. Depends on the brokerage you go through. So again, do some research and figure out which one's best for you and what has the best fees. But understand that those fees do erode at your gains. So comparing like a Vanguard fee, which could be very low, it could be literally for a basic index fund, it could be 0.1% compared to 1%. So that means that, let's say you have a yearly return of 8%. That's the standard in the S&P 500. If you're paying somebody 1% in fees, you now have a return of only 7%. Versus if you are doing an index fund and it only has 0.1% fees, you are now, out of that 8%, you are getting 7.9% of that return. So understanding fees and how those can erode into your compounding interest is really important. And again, finding a little bit that you can invest into is really important. The key is to start and keep funding it, because over time, when we look at the Dow, when we look at the S&P 500, we look at US stocks just in general as an example. Again, long term, if you are going to leave it in there as long as you can, and I'm talking, when I say long, I'm talking 10, 20, 30, 40, 50 years to allow that exponential growth, that's where you can spread out over those indices and you can keep funding that account, and you will really see a takeoff in how much money you have in the stock market and how your money is growing without you. Once you put it in there, you don't do anything. That's it. You're not trading more hours. You're not having to go to work and work 2 more hours to make that money grow. You are putting it in there so it grows. One of the smartest and best investors out there, Warren Buffett, has been doing this a long time. He commonly states that if you don't figure out a way for your money to grow while you sleep, you will always be behind. If you just put in a savings account, because inflation and things over time will get more expensive, you will be behind the 8 ball. Using stocks and using assets to grow your wealth is how you get in front of the 8 ball and how you actually get ahead of the game from that standpoint. Some of you may already be doing some of this in a 401k or an IRA through your company. And that's another way you can do it. Again, taking advantage of what your company offers. Make sure you look at it. What is it? Is it a 401k? It can be different if you work for government or if you work in public sector. Sometimes it's something like a 401b instead of a 401k. There's a lot of examples in it. Understanding like what are the benefits of being in there? What programs do they offer? Some of them have some kind of cruddy fees. And so it might not be worth investing in those. You might be better doing it on your own in your own IRA, or you might be better off just doing it with your paycheck and putting money into a standard brokerage account after you've already paid taxes and all that money. There are advantages to doing IRAs and 401ks, and we're not going to get into all of that today with some of the tax advantages. The key that we really want to harp on today is you should have some form or way that you are investing money, whether it be through your W-2 job in a 401k or 401b or anything else they might have to offer, whether it be for putting money aside every paycheck and putting it into an after-tax account where you're buying stocks and indices on like Vanguard or E-Trade as an example. But doing that will help you grow your wealth. And you need to, once you get past the savings part of having an emergency fund and all that, the next step is really to figure out how you are tackling that compound interest and how are you getting that compound interest to help your money grow over time. Hope this was helpful today, give you a little bit of basics. I'll put all the companies that we mentioned today and some of the glossary of words that we talked about today in the show notes. But please, if you have any questions, reach out. If you like the content that we're providing, please make sure you're subscribing to our podcast anywhere that you get your podcast, as well as we are on YouTube and we have these videos uploaded on YouTube, or you can subscribe there as well. So thank you for joining today. I hope you have a great day. Let's continue to grow our net wealth nest together. Bye, y'all. Net Wealth Nest LLC and Podcast is an educational platform committed to providing resources and information to empower individuals on their financial journey. Please note, we do not provide financial, tax, or investment advice. All financial decisions should be made in consultation with a qualified professional who understands your unique circumstances. Seeking personalized advice is a smart and necessary step before making any major financial commitments. Thanks so much for joining us today. If you found value in this episode, please like and subscribe to our YouTube channel, Net Wealth Nest, and leave us a review on your favorite podcast platform. We read every comment, and they help us improve and guide what topics we dive into next. And hey, if something you heard today resonated with you, don't keep it to yourself. Share it with a friend, a family member, a coworker, your barber, your barista, even a stranger in line. You never know who might need this message. Remember, building net wealth is a journey, but you don't have to do it alone. Stick with us, and together, let's grow your net wealth nest.